So we're going to talk about how to position in an uncertain market, and it certainly seems like the only certainty out there is that the market direction is uncertain, and it's really been the case since we made that top back in January of 2018. It's kind of interesting to me that with all the attention on the 200-day moving average, that not a lot of people really point out the fact that the 200-day moving average is flat, right? We've essentially gone nowhere for about a year and a half, so that's kind of interesting to me. So. We're going to start by just kind of looking at the state of the market and what I think looks interesting right now. From there, we'll introduce the Chaikin power gauge and how it leads to the relative strength and weakness in the market. And then we'll kind of highlight two areas that I like right now and two areas that I dislike right now. And Tom stole a little bit of my thunder with the dislike areas, but that's okay. We'll dig into them. We'll dig into them a little bit further and kind of see how I see them. First, just a quick disclaimer. We are not registered as a broker-dealer, and nothing I say here should be considered investment advice. A little bit of background on myself. I've been on the street for 19 years. I'm a former New York Stock Exchange market maker, and I actually started working down on the floor of the New York Stock Exchange when I was 16 years old. Fortunate enough to be given that opportunity, and it was a lot of fun, and I really enjoyed it. Currently, I am a chartered market technician, so that means that I passed all 3 levels of the CMT exam to earn the right to use the designation of chartered market technician. From there, I was asked to be the chairman of the New York chapter of the CMT Association, which was a huge honor to me, and kind of puts me in contact every day to day with a lot of really, really smart people, some of whom you have on this show from time to time. I know you have Dave Keller on from time to time. Dave is a friend who I met through the CMT Association. So prior to joining Chaikin Analytics about 10 years ago, about a year and a half ago, rather, I spent 10 years covering large institutional investors who I'm still in contact with a lot of them today. So the large mutual funds and hedge funds and pension funds around the country, a lot of names that you would recognize if you saw them, are friends of mine and former clients. So great opportunity for me to kind of be in contact with some really smart people who are running large amounts of money on a daily basis. I'm a frequent guest on Bloomberg TV. As I said, I was there last night, and I always like to use that action shot of myself calling for the market to go higher from 27, 26, which it did. And most recently, something else that I'm really proud of is I was asked to take over teaching the technical analysis class at Baruch College in New York City. So that's been a fun new learning experience for me that I've really enjoyed. And I can honestly say after half of one semester, I'm excited for summer break. I get where teachers come from, and I feel bad for what I put my teachers through. So for me right now, the S&P 500 is consolidating, but with bearish momentum. Here's a chart, just going back a year, the S&P 500, there's that flat 200-day moving average, and this does not incorporate today's activity. I put these slides together last night after the market closed, but flat 200-day moving average, we tested it yesterday. For me, to really get bullish, I need to see a break of the near-term downtrend with a move back above 2850 and ultimately a move through 2950 for the uptrend to really be reasserting itself. And I do think that if the 200-day moving average does give way, we have to start thinking about 2720 to the downside. That's actually a 38% retracement of the move from the December lows to the May highs. And from there, I think you want to think about 2650. That's a 50% retracement of the same move. And what's interesting to me, as I'll show you in a little while, is it's just more than just the chart activity that's driving that view. The Chaikin power gauge, which I will introduce in a little bit, ranks all the stocks in the S&P 500. And coming into yesterday, for the first time in a while, there were actually more bearish stocks than bullish stocks within our model. But we'll dig into that in a little bit. Here's that RSI. This is what I mean when I'm talking about bearish momentum. RSI is broken below 50, and on subsequent rallies has not been able to get back above that 50 level. Looks to me like momentum is shifting to the downside. So similar to Tom, to what you were talking about with the PPO on the TNX, I'm seeing a similar dynamic starting to take shape for the S&P 500, and then ever so slightly, Chaikin money flow dipped into negative territory with the move down yesterday. Small caps continue to underperform. We've been pretty bearish on small caps relative to large caps for a while. What we're looking at here is the chart of the IWM relative to the SPY. Clear downtrend below the 200-day moving average. Similar dynamic for momentum seems to have shifted into bearish ranges. And all the while, there's this strong resistance level for IWM on an absolute basis. And it's just kind of interesting to note that while the S&P 500 was tagging new highs on May 1st, IWM was nowhere close. So we continue to favor large caps over small caps. And again, more bearish stocks than bullish stocks in the IWM. So another just kind of sign of potential weakness going further. We do prefer growth over value. Last time I was on here, I went through my thesis on, in a slowing growth environment, investors are likely to pay a premium for growth. And I highlighted IVW as a way to take advantage of that. So what we're looking at here is IVW. This is the iShares S&P 500 growth ETF relative to the S&P 500. And clear outperformance above the rising 200-day moving average. And now we've broken out of this consolidation. All the while, complete opposite here for momentum. Momentum staying solidly in bullish ranges. So I think growth likely to continue to outperform. So as you're kind of walking through ideas, one of the areas of the market where you want to be considering long ideas or stocks to add to the portfolio are those from the quote unquote growth area. And what I watch closely are semiconductors, especially semiconductors on a relative basis. This is the SOX relative to the SPY. And yesterday was the stocks actually outperformed in a down tape yesterday, and the semis are outperforming today. To me, this is my tell for the market. If this relationship can stabilize at this support level and it is oversold for the time being, I think the S&P 500 can find support at the 200-day moving average and turn higher. If semis continue to break down relative to the market, and I have reason to believe that they could, because if I look at the stocks again through the lens of our model at Chaikin Analytics, there are more bearish stocks than bullish stocks. To the extent that they break down on a relative basis, I think we could see more weakness for the S&P 500. But really right now, semis are what's driving my view. If they break down, I think the odds increase that the S&P 500 will break its 200-day moving average. Yields remain the big story. Tom, you showed a great chart. I'm kind of just being a little redundant here with this one. Again, though, the other part of the thesis the last time I was here was in a slowing growth environment, central banks would find it hard to raise rates, and the path of least resistance for yields is likely lower, and that would lead investors to favor yield products, either treasury ETFs or yield plays within the equity market. And what we've seen is real estate outperforming, utilities outperforming. Here's TNX heading down. Tom, I have the same level highlighted that you did. And, I use RSI as my gauge of momentum. So your PPO and my RSI line up just solidly within bearish ranges. So to me, I still think the path of least resistance is lower for yields. Wouldn't be surprised if we traded down to the 2% to the 2.1% level.
Hey, Dan.
Yes.
I got a question for you on that. If you go back to that chart, I ask all our guests the same question. I keep trying to find somebody that agrees with me. So
when people disagree with you, I find that that's better.
Oh, well, okay.
But I always disagree with you.
That's good. I guess that's good then.
Well, it just kind of gets back to sentiment and consent. Like, you don't want to be consensus, right?
Right. No, that's true. You don't want to be within the masses. But the point I was making is while the 10-year treasury yield's been going down, and I usually use that as a gauge of what the bond market views about our economy. But it can also have an inflation or deflation component in it. And I see today the UUP, which is a dollar index bullish fund, is threatening another breakout to the upside. That rising dollar continues to pressure commodities.
Yep.
Prices. And so another possibility that I'm going to still cling to, whether I can get anybody to agree with me or not, is that the rates falling. While, yes, I think part of it is the fact that we could see economic weakness ahead, or at least not as much growth as we were earlier forecasting. But I think it's also a message that the bond market is sending to the Fed that don't forget about deflation. I mean, we're not up to their inflation targets. We've been coming in light. And in the Fed's last statement, they said that they thought the lower inflation was transitory, that, in other words, it was going to all of a sudden move back up. But when you look at commodity prices and you see oil going down and you see, copper prices dropping and so forth, silver, how are we going to have inflation going back, up to create this inflation that the Fed's talking about? I'm seeing the opposite. And I'm just wondering, when you look at this 10-year treasury yield dropping from 325 to 225, I mean, it's a full point.
Yeah, it's unbelievable. And I actually think you are looking at it the right way. And I think that there's almost this kind of vicious feedback loop, right? But for me, it actually starts with rates in global developed markets, right? So even at 2.23% as of last night's close, our 10-year looks really good relative to the rest of the global developed markets, right? When you consider Japan and Germany are negative on the 10-year, right? Australia is below 2%. The UK is below 2%. We look really good to global investors searching for yield. So here's the loop, right? Our yields on a relative basis are higher than the rest of the world. Buy dollars to buy treasuries, right?
Yep.
Forces the dollar higher, forces yields lower, forces commodities lower, and then repeat, right? Rinse and repeat.
But is this going to be
we have this, we're kind of the best house in town from a yield standpoint. So if you're a foreign investor, you're going to come here searching for yields. I think that continues to put upward pressure on our dollar, downward pressure on our yields, and the rising dollar impacts commodities. So I'm in agreement with you. We might not get there exactly the same way, but I am in agreement with you.
But doesn't the Fed need to lower rates to weaken the dollar to stop this spiral?
It could be that, Fed game theory on the Fed is above my pay grade. I wish I don't have a good read there based on my process. I'm just kind of seeing the trends that are in place. The bond market's certainly telling you that they think that's the case. I mean, I think, the Fed funds futures market is now pricing in a full rate cut by the end of this year and potentially one or two more next year. So I think people are starting to get into that camp in the futures market. So
yeah,
it does seem that there are people who do agree with you, Tom.
All right. Well, you just agreed with me. So Gretchen, Zach, we need to schedule to get Dan back on more frequently.
So one of the ways that we've liked to play the falling rates is through the IEF. This is the iShares 7 to 10 year Treasury bond ETF. Just nice steady uptrend, and the scooter at the bottom kind of tells you the whole picture. For those of you who've heard me present here before, the importance that I place on relative strength. Scooter, great way to see that within StockCharts.com. And while I think we're probably a little bit overdone here in the near term, this is a solid trend that's likely to continue. And for those of you who want to express the view in the equity markets, we're going to look at that in a minute. But kind of for us, the key mantra for us and what drives everything we do is that actually fundamentals drive the market. We can talk about sentiment, we can talk about anything you want, but at the end of the day, longer term, bigger picture, fundamentals drive the market, and it's our emotions and our sentiments in the shorter term that drive the market to extremes. And what we believe is that combining fundamentals and technicals is the best way to outperform the market. And wherever possible, we want to take emotions out of the equation. And the way that we do that is with the Chaikin Power Gauge. Powerful tool, your GPS for the market, combines fundamentals. It's actually 85% fundamental, which a lot of people are surprised by when they consider Mark Chaikin created it. He's well known as a technician. Many of you probably use his indicators. I'm a CMT, and I firmly believe this. Fundamentals drive the market. I love using a fundamental model in conjunction with technicals to try to give our clients an edge in the marketplace and really level the playing field when it comes to competing in the market. So it's an unbiased model. It's completely unemotional. Looks at financials. That's the value type metrics folks like Warren Buffett look at. It looks at earnings. So the things that your growth and momentum type investors look at. Obviously, there is a technicals component to it, in particular, relative strength and Chaikin money flow being two keys there. And then our kind of secret sauce is experts, right? We are looking at what the market participants are seeing and doing. So we look at what analysts are doing with their estimates. We look at what analysts are doing with their ratings. We look at what the insiders are doing, and we look at what the short sellers are doing, and we roll all that up every night into a rating on over 4,000 U.S. listed equities that runs from either very bullish to very bearish, knowing that our bullish and very bullish stocks tend to outperform the market. And the reason we like models is because I've stolen this quote from Jim O'Shaughnessy, a famous and very successful quantitative analyst and investment portfolio manager. Models beat human forecasters because they reliably and consistently apply the same criteria time after time, as opposed to human beings who are swayed by emotions and opinions. And we've all been there. You all know how you felt on December 23rd or December 24th as the market was plumbing towards those 2350 lows. It's scary. Your emotions can get in the way, and we try to eliminate it as much as possible. And I underline that word because I really do think it's important. So the way that we find relative strength in the market is driven, everything we do is driven by the power gauge and the power gauge rating. What we can do very quickly is start to look at the sectors of the market that have more bullishly ranked stocks than bearish stocks, right? So if we look at financials, 27 bulls to 1 bear, right? Utilities, here's your defensive posture. Utilities, healthcare, right? 8 bullish or very bullish stocks and utilities for only 2 bearish stocks, and so on and so forth. And then, Tom, you mentioned materials and energy. They've actually been 2 of my least favorite areas of the market. And here's why. They have perpetually both been at the bottom of this list for months now. And we'll take a look at a really interesting chart that takes it a step further as it relates to energy. And we can kind of drill down. Once we've identified strong sectors, we can drill down to the industry level at the same thing. The power gauge rating drives everything we do. My views on the insurance industry don't come into play. Power gauge rating tells me that insurance has 30 bullish stocks and 2 bearish stocks. I want to be looking for long ideas in insurance. At the same time, oil and gas, equipment, transports, I want to be avoiding that area of the market. Regardless of my feelings on the groups, I let the power gauge rating drive the way. So real estate is a market leader. IYR is a U.S. real estate ETF. And you can see here, this is our measure of relative strength. It's been outperforming the market for quite some time and recently started to do so again. So real estate is an area of the market, again, plays on that decline in rates. Real estate is an area of the market where we have been doing some good hunting for long ideas and been successful for our clients for the most part. Recent very bullish idea, very bullish meaning that's its rating at Chaikin Analytics. American Home for Rent, AMH, nice steady uptrend with bullish money flow, persistently bullish money flow really since the beginning of the year, and Scooter in a nice uptrend. But it's the power gauge rating that tells me that all of this is likely to continue. So American Home for Rent is not a name that's on a lot of people's radar screens. Another aspect of kind of taking your emotions out of the equations is it opens you up to find new ideas. I found this one recently, and it looks good, and I think it continues to look good. I do like tech, but I like playing tech right now, just given a lot of the volatility in the marketplace. I like playing it through the real estate lens. Equinix, EQIX, is a bullish stock at Chaikin Analytics, and they basically own the buildings and the property where a lot of the big companies store their equipment, their servers. So it's a play on tech with a real estate bent to it. Nice steady uptrend above the 200-day moving average. Bullish rating at Chaikin Analytics. Here's that Scooter score, up at around 95.5, likely to persist going forward as the fundamentals and technicals here look good. Financials, I showed you, are at the top of the list. So the fundamentals for financials are bullish. But what's interesting to me and why I place so much importance on relative strength is, despite the bullish fundamentals, and this is why the combination of fundamentals and technicals is also important, financials as a broad group haven't really shown us much in the way of relative performance. We've had to dig below the surface. So we talked about insurance. Look at the relative performance for insurance here based on our relative strength metric. KIE is the insurance ETF. It has a very bullish ETF rating at Chaikin Analytics. Nice uptrend. Bullish Chaikin money flow, just likely to continue to outperform the market. It's an area where we want to go hunting for long ideas, stocks that have bullish or very bullish ratings. So Metlife looks interesting to me as it consolidates and holds above support. Scooter moving in the right direction, so we have the relative strength. Chaikin money flow is green, telling us that institutional investors are accumulating the stock, and it has a very bullish rating within our model. So Metlife, name that looks compelling to me in the here and now. I actually made it my bullish stock of the day earlier this week. Another name that looks compelling, more so because of the model and what I think is likely to happen. Allstate, right? consolidating here, but it does have a very bullish Chaikin power gauge rating. And what we can see from the scooter is it's broken this downtrend line and is beginning to outperform the market as money flow starts to get bullish. We're holding above that flat 200-day moving average, but I think that this is a stock that's likely to continue to outperform the market, because we're starting to see it in the relative strength, and our model is very bullish. So that is another name that I would focus on the long side. Now, Tom, you mentioned energy. Energy is a name that we've been bearish on, or an area of the market that we've been bearish on. It has a bearish ETF rating. This is the XLE, but I want you to focus in on this box right here, because this is our measure of relative strength, and it has been a persistent and intense underperformer since December. And the reason I'm highlighting December is because look at what started to happen in December. This is that crude chart. So even as crude rallied from the 42, 43 level up to the 66, 67 mark from the lows in December, the oil stocks were not having any part of that rally. And the entire time, we were, for the most part, we're bearish on the group in our fundamental and technical model, right? So that's kind of interesting to me. I was getting so many questions. Dan, why are you so negative on energy? Oil's rallying. Because the model tells me to be negative on energy. And it worked out. We were able to identify names like Concho with a very bearish rating. This was my bearish pick of the day a week ago today. So if you sold the open on my pick of the week, you have done pretty well. Very bearish stock. Look at this scooter, massively underperforming the market. Institutions cannot sell it fast enough. Persistently bearish. Money flow, another name that's just been a constant to avoid, right? You talked about bottom fishing, Tom. A lot of people like to go bottom fishing and beaten down names. Halliburton has been bearish in our model for roughly a year. And even as it tried to pick up its head with oil, we stayed bearish. Stock was continuously underperforming the market. And now look what's happened recently. These stocks could not do well while oil was rallying, and now oil's rolling over, and they're completely breaking down. So Halliburton is a name that we've been able to identify on the bearish side of the portfolio as well. And Tom, you spent a lot of time talking about retail. I think retail is weak and getting weaker. I think what's happening here is investors are starting to price in the potential margin impacts of tariffs. But that's just my view, and that's my opinion. What drives my thoughts, though, is the bearish rating on the retail ETF. Look at this. 39 bearish or very bearish stocks in our model, only 6 bullish or very bullish stocks. Persistently underperforming. It's not new. It's not because of the tariffs that retail is all of a sudden falling out of bed. It's been underperforming since November. And the intensity is just starting to pick up now with the tariff concerns, right? So we're very bearish on a name that looks like it's just starting to roll over. Advanced auto parts, and kind of interesting to me, we've lost the 200-day moving average. Rally attempt failed, and we are heading back down. Again, very bearish rating within our model. Scooter telling you that the relative strength is no longer there. We're heading in the wrong direction. This looks like a compelling name to avoid, or if you do play to the bearish side, to look for opportunities to open bearish positions in advanced auto parts. And this has been a market darling for some time. So as the crowd starts to see what's going on here, we want to get you out in front of it. Another one that was interesting to me, and I'm kind of cherry picking this one a little bit, but it's with good reason. Gap, right, was in a tailspin, and they throw the Hail Mary pass. They're going to spin out Old Navy, and the stock rips, and everybody starts to get excited because this is going to change the company and unlock Old Navy's profitability. All the while, our model stayed bearish. Told you our model was not buying the special situation, right? And the stock has done nothing but head lower ever since, underperforming the market with massively bearish money flow for the most part. So think what you want about Old Navy, the Gap, Banana Republic, anything else. The model told you to stay bearish, so we did. So that's it. The Chaikin power gauge drives everything that we do. It really does help you kind of navigate, survive, and thrive despite no matter what the market's doing. And we're really excited because we just rolled out a new product. It's called the Market Survival Guide. It's a weekly note plus actionable alerts, comes out every Tuesday morning, where I kind of look at the market similarly to the way I did here, across asset classes, what's outperforming, what's underperforming, where can you find opportunities regardless of what the market's doing. And we normally sell this for $49.99 a month, but I told the team that I was coming on the show that I wanted to give you guys a great deal. So we are knocking it down to the lowest price per month that you're likely to see it, $29.99 a month. As I said, weekly newsletter comes out every Tuesday. One of the best reads out there today. It's clear and to the point with a well thought out process that you can easily understand. This is recent feedback that we received. We just launched this product 2 months ago, and you'll get intra-week alerts. We host a weekly call every Wednesday afternoon. We host an hour and a half, 2-hour call, myself and one of my coworkers going through our thoughts on the market, taking everybody's questions. So again, if you head over to chaikinanalytics.com/guide, you can grab this product for the lowest price per month you're likely to see it. And if you're not happy, we have a 30-day money-back guarantee. We're happy to cancel you out at any time. So that's my current views on the market.
All right. Well, there are some questions in the room.
I love questions.
Yeah. And I'm going to kind of summarize the questions because there was a number talking about basically directional. What do you think the overall market is going to be doing? And I'm talking about, not only short term, you're looking at the 200-day moving average. And that, of course, that's a question in the poll. Make sure everybody takes that. If you don't mind, we're going to talk about that in just a minute. But even going out a few months, questions are out there as to what your take is as we go into these summer months, which typically, can be a little bit difficult for the market. I mean, historically, the summertime we see not quite as good a performance as we do other times of the year. So just a, quick summary, what are you all thinking about the market here? I mean, do you think that we do break down and go down to that 26 and change to get that?
I think that if we continue to see a deterioration in our model. So if we continue to see the ratio of bearish stocks to bullish stocks within our model continue to grow, i.e. more bearish than bullish stocks, to me that increases the odds because it's forward looking and it looks at the stock level. Remember, it's a market of stocks, right? Ultimately, it's the stocks that drive the index, and you're going to see individual stocks will start to break down before the actual index does, right? We're starting to see it in small caps. We're starting to see it in semiconductors, right? Everybody loves to talk about the market. And the point that I would make is I think we're choppy at best in a broad range over the next 3 months. I think that if we do see that deterioration in our model and a break of the 200-day moving average, I do think 2650 is a very real possibility. At the same time, we could just as easily start to reverse and head back up towards 2900. So what I think is, I think we could be in for some choppy trading, which is why it's going to be important to go below the surface, because within that choppy trading, you're going to be able to find the relative strength. I've been on here. I've talked about the importance of relative strength. I mean, Tom, you called it out with Vive, right? That when the market was cratering in December, Viva Systems held up, right? Kind of went sideways. And then what happened? As the market started to rebound, it was a massive outperformer. I think you're going to be able to look below the surface to the sector and industry level. And regardless of the chop in the market, you're going to find areas of outperformance. And that's where you should focus your long ideas. And you're going to find areas of underperformance. And that's where you should focus on your bearish ideas, or just avoid those areas of the market completely. So I think odds favor choppy trading. And this is dynamic, right? We kind of think of, we view the market in a Bayesian way, right? Every time we get new information, we update our probabilities, right? If you ask me on Friday, there were more bullish stocks than bearish stocks on the S&P 500 in our model. So if you ask me on Friday, do you think the 200-day is going to hold? I would have more confidence. I'd say, yeah, that's a higher probability event that it's going to hold. Ask me today, when there's more bearish stocks than bullish stocks, I think the odds of us breaking down just went up. So we adjust every day.
Yeah. Well, I do have one chart I'm going to bring up before we go into the poll, if you don't mind. And you talked about energy and materials. And I just wanted to show this chart because this is a 20-year weekly chart. So on the top is the XLE versus the S&P 500, and on the bottom is the US dollar index. And for somebody who's, has questions about energy and materials and why don't you like this group and so forth, first of all, I completely agree with your analysis. I mean, energy, materials, I think that they should just completely be ignored. I don't like the groups. And I think there's going to need to be a change in the overall trend of the dollar before I would change that stance. If you look back at the last bull market we had from 2002 to 2007, we had a declining dollar. And as a result, energy was a leader in that bull. But once we made this huge move in the US dollar, breaking this downtrend, I don't think there's any question that downtrend had ended when we had this huge move. Look at the relative strength breakdown across multiple years, relative support, and we lost that. And we have been downtrending while we continue to uptrend. And one of the things that really that caught my eye is even when the dollar went through that period of decline, still there was no money rotating into energy. So I think that speaks volumes. I think as long as the dollar continues moving up, I think energy and materials on a relative basis are going to underperform. And if you're trying to outperform the S&P 500, the more money you have in underperforming areas, the more difficult it is to outperform the benchmark. So I'm avoiding the two areas. I do believe that if the Fed does begin to lower rates, the Fed's, being kind of stubborn like they were at the end of 2018, saying, that this is transitory, no problem. Inflation's going to come back up. I don't think it's going to. And I think the Fed is going to do exactly what they did in December, which is crater to the market. And they're going to come back and lower rates. And when they lower rates, let's see what happens to the dollar, because it is our rates versus global rates. It's not just what's going on here in the US. But if we do start to drop rates and the dollar begins to fall, then I think energy and materials could be something to consider.
Yeah, and that gets into that again, gets back into the dynamics, right? You're looking at probabilities right now. Odds favor rates going lower, dollar going higher. We want to avoid energy. We want to avoid materials. I showed you how within our model they are the two weakest sectors of the market as it relates to percentage of bullish stocks and bearish stocks within each sector. But of course, if something changed, you have to adjust your probabilities. And what I suspect is you'd actually start to see the stocks move before that.
Yep. All right. Well, we're going to go into the poll because I know you're anxious to see what
I love the poll.
Audience thinks about the 200-day. And I mean, we're almost right on the 200-day. So I would have expected a high response on the yes side. So I'm not.
Yeah, but 3-1, huh? 76% say yes, 24% say no.
So what do you think? You think we go down first and then bounce?
I think that the odds of us breaking have increased based on what I'm seeing in our model. And should we break the 200-day moving average and kind of close below it, I think it's a very real possibility that we could go to 2650. 27. I don't think we go there in a straight line. I think you want to think about 2720 and then through there 2650. But to me, it's contingent on two things. Semis continuing to be weak, which leads to the S&P 500 breaking the 200-day moving average.
Yeah. I'm going to say no. I'm going with the minority. I don't believe we're going to break it to the downside.
It's almost too obvious, right?
Yeah.
Everybody's watching this and everybody's waiting. So it's almost too obvious. That's kind of what it feels like to me, right? I mean, we've been doing this a long time. The market wants to make the market's sole job is to inflict the greatest amount of pain on the greatest amount of participants at any given time. So if everybody's kind of getting short in anticipation of the break, we're not going to break.
Well, here's where I'm coming from. And Aaron, I want to get your thoughts too. But the reason I'm saying no is that historically we're at the end of May, heading into June, normally money flow coming into the market beginning of the month. We have portfolio managers that position, ahead of that money coming in. Historically, and I've said this going into this week, from May 26th to June 5th is one of the most bullish historical periods of the year. So I think over the next week, I don't think we're going to do it. I believe we're going to bounce as we go into the beginning of June. After that, I don't know.
No, it's kind of interesting. And seasonals don't drive what I do, but obviously I pay attention to them. And, the selling may go away for all its criticisms, and it has its fans as well. And it's kind of worked this year. But historically, it's those latter 3 months of sell and may go away that are the weakest.
No doubt.
You generally get some bullishness in July through as we get through earnings season, and it's kind of really August, September, October that are the weaker half of that weaker 6-month period.
Right. I agree. Aaron, before we go, what do you think? What
do you think that I would do?
Yes.
I did say yes. But, I'm looking at my models, my own, indicators, and they're so weak. I'm seeing a possible head and shoulders. I mean, Larry Williams, I'm sure you know him, Dan.
Of course.
He was on the show yesterday, and he's looking at 2,700. So,
and realistically,
I just don't see enough good stuff going on. I don't think we're going to break down, honestly, much below 27.25. I don't think it's going to be super painful. I don't think the head and shoulders I'm seeing is going to actually activate and get us down to the target, which would be right around that 2,600 level. I'm not.
Yeah, and then 27. So 27.25, 27.20 is a 38.2% retracement of the move off from the December low to the May 1st high. Like perfectly normal.
Right.
Perfectly normal. Even 2650. 2650 would be a 50% retracement, and it would be roughly 10% off the highs.
Right.
Perfectly normal. Everybody will freak out.
Right.
But perfectly normal.
Yeah, it'll be interesting to see. I can't get that bearish. I mean, by the time we move to that level, I'll be interested to see my indicators. They'll probably be pretty oversold. So
I would think so.
Yeah. Right, we got to run, Dan, but it's always a pleasure having you on here, and
always great being here.
Great information. Always love to hear from you. So I love
being here. Thank you.
All right. Appreciate it.
Have a great day, everyone.